34%. That's what my portfolio lost in 33 days. My thumb was on the sell button for about 4 seconds. That's the whole video, honestly. Those 4 seconds. Everything else is just how I got there and what I found out afterward that changed how I think about all of it. 4 things by the end of this video. 1. What actually happened in those 4 seconds and what almost made me press it. 2. A number from an independent research firm that tracks this exact behavior across millions of investors, and it's not the number you'd guess. 3. What that same 4 seconds is worth in real dollars 20 years later. And 4. The part nobody asks about, why almost everyone believes the wrong number in the first place, including me, until I checked. Everyone assumes most people panic and sell in a crash. I did too. Let's go. A few years back, I had $61,000 in a taxable brokerage account, index funds mostly, nothing exotic, 3 years of automatic contributions, same amount, same date, every month. I barely looked at it. That was the whole strategy, boring on purpose. The same account I'd started building right after I got serious about where my paycheck was actually going. Then the market dropped 34% in 33 days, one of the fastest drops in market history, verified on record. $61,000 became just over $40,000. That's not a typo, that's 5 weeks, and that's exactly when the 4 seconds from the start of this video happened. I'm John, no finance degree, no advisor license, nobody handed me a shortcut. Everything on this channel is just what I actually did, mistakes included. If that's the kind of channel you're after, subscribing costs you nothing and helps me more than you'd think. New video in 2 days. Now, back to those 4 seconds. Day 21. Down 40% from the peak at one point intraday. My phone won't stop. Group chat. My brother-in-law asking if I'd gotten out yet. A headline that says the word unprecedented for the 4th time that week. Every screen I open has some version of the same sentence. Get out while you still can. My thumb is on the button. 4 seconds. I'm not going to tell you what happened next yet, because the reason it mattered isn't the 4 seconds. It's a decision I'd made 3 years earlier, before I ever needed it. I wasn't the only one getting messages that week. David, a guy I know from a sales job years back, good income, no real savings habit, texted me 11 times in 2 days. Same message, different words. Get out now. Then there was Priya, senior analyst, the kind of person who's had a real portfolio since her 20s. I asked her what she was doing. Her answer was one line, I haven't looked. Why would I? Same crash, same headlines, same market, 2 people, 2 completely different relationships with that sell button. And it had nothing to do with how much money either of us had. It had to do with a decision made way before the crash ever started. 3 years before that crash, I wrote one sentence in a notes app, not a strategy, not a spreadsheet, one sentence. If it drops, I don't touch it. Decided now, not then. I wasn't deciding whether to sell in the moment. I'd already decided. The version of me with the calm head made the call for the version of me who'd be scared out of his mind later. That's the whole trick, if you can even call it that. Priya had her own version of that sentence. David never wrote one down at all. It's the same sentence a CFO I know, Gerald, never got around to writing about a payroll advance he almost had to ask for. Some decisions are cheaper made in advance than made in a panic. Here's what I assumed going into this video, that most people panic sell in a crash. Almost everyone assumes that. It's not true. After the 1987 crash, researchers surveyed mutual fund investors directly. About 5% had actually sold, not 80, 5. So if almost nobody sells in the moment, not me, not David, not the millions of people this research actually tracked, why does the average investor still end up so far behind the market? DALBAR tracks this every year. In 2024, the average equity investor earned 16.54%. The market, the S&P 500, returned 25.02%. It's not one dramatic sell-off. It's years of small mistimed moves, selling a little late, buying back in a little later. Nobody panics all at once. They just bleed, slowly, for decades. So why did I believe 80% for so long? There's a name for this in behavioral psychology, the availability heuristic. Basically, the easier something is to picture, the more common we assume it is. And a trading floor in chaos is a lot easier to picture than 5% of people quietly clicking sell in their kitchen. The dramatic version gets replayed. The boring version, which is what actually happened to almost everyone, including me, never makes the news. That's the trap, not the crash itself. The story we tell ourselves about how everyone else behaves in one. I nearly made a decision based on a number that was never true. There's actually a group in this story who did better than David, better than me, better than almost anyone I've mentioned so far. Marcus, a director 2 levels up from me, never paused his contributions during those 33 days. Same percentage of every paycheck, same day of the month, automatically into the same funds, the whole way down and the whole way back up. He wasn't being brave. He told me later he didn't fully register the crash was still going on by the time it ended because his contribution never changed and he never opened the app to check. Here's why that matters more than it sounds like it should. Every paycheck that went in during those 5 weeks bought more shares for the same amount of money because the price was lower. There's a name for this too, dollar cost averaging into a downturn. It's one of the only times a crash statistically works in your favor, but only if the money keeps going in instead of stopping. Marcus's balance dropped just as much as mine did, on paper, at the bottom. But because he never stopped buying, the shares he picked up during those 5 weeks turned into some of the best performing dollars in his entire portfolio once the market recovered. He didn't do anything clever, he just never noticed there was a decision to make in the first place, which might honestly be a more reliable version of the sentence I wrote 3 years in advance. Over 20 years, the average investor earns about 8.7% a year. The market itself averages 9.7%. 1 percentage point doesn't sound like much. On $1 million over 20 years, that 1 percentage point is the difference between 5.3 million and 6.3 million. A full extra million gone, not from a crash, from thousands of small 4-second decisions made by people who never wrote their sentence down. I'm not going to pretend I have some secret system. What I have is smaller than that, and Marcus's story only adds one more piece to it. 1. Write the rule down before you need it. Not, I'll figure it out if it drops. An actual sentence, dated, sitting somewhere you'll see it. 2. Automate the part that shouldn't require a decision. The contribution, not the reaction. 3. Decide in advance how often you're even going to look, because Priya's answer, I haven't looked, why would I, isn't magic. It's a rule she made on a calm day, the same as mine. So, the 4 seconds. I put the phone down, didn't sell, not because I was brave, because 3 years earlier, a calmer version of me had already made the call. That account crossed $61,000 again 14 months later. Today it's worth more than 4 times what it was at the bottom. I don't say that to brag. I say it because the only skill involved was not touching it and not believing a number that was never true in the first place. Here's where the 4 of us actually ended up, since I think that matters more than the crash itself. I don't know for certain if David sold that week. He told me he came just as close as I did and stepped back at the last second too, so maybe the myth got 2 of us instead of none. Priya's portfolio predictably is fine. Last time I asked, she still hadn't looked. Marcus's automatic contributions during those 5 weeks turned into some of the best performing dollars in his entire account once the recovery came. And Gerald, the CFO from that payroll story, is the only one of the 4 of us who actually got hurt by a decision made in the moment, and it wasn't even about stocks. 4 people, 4 completely different relationships with a 4-second decision, and the thing that predicted how it turned out wasn't intelligence, or income, or luck. It was simply whether the decision had already been made before anyone needed it. The data says almost nobody panics in the dramatic moment. The data also says almost everybody loses to 1,000 quiet ones. If you only prepare for the 4 seconds, you're preparing for the wrong test. None of this changes anything for you if you just watch it and move on. So here's the one thing I'll ask. Subscribe. Not for me, for the next file, because it builds directly on this one. It takes about 4 seconds, less time than it took David to decide on that 5th car. 2 days. See you there. Next video, a co-worker whose car kept getting nicer every single year for 10 years straight. I'll show you exactly what that was actually costing him the whole time. Dropping in 48 hours. See you there.